Welcome back to the Pass Your Life and Health Insurance Exam well, podcast. But this is our challenge, our 5 day Pass Your Life Insurance Exam challenge. So, yeah, if you're just joining us for the first time, this is our challenge. The goal of the challenge is to get you to hopefully be prepared within 5 days uh, to pass your life insurance exam. So we do things a little differently for the challenge. That's why it's called challenge. It's going to challenge you. It's not something easy. It's not a class where you just come and you know listen and go and do nothing. You come and learn, and you're going to go and practice what you learn. So it's a challenge. It's rigorous, but if you do all your assignments, hopefully within 5 days you should be prepared to take your exam or very close to taking your exam. So we started yesterday. Yesterday was day one, and this is the first batch of our challenge. So this is the first cohort. Our goal is to do this at least once every month, but if there's a lot of demand, we will even do it twice a month. So I have here our only student for now. There were four other people who signed up, but I guess it's live, right? A lot of people start, but a lot of people don't finish. So she signed up, but she's here. Her name is Lexie Estrada from South Carolina. So Lexie, just a little, I know you did this yesterday, but just a little reintroduction for those listening to you on the podcast.
Okay. Yeah. My name's Lexi. I am living in South Carolina right now in Charleston.
Mhm,
And I've been listening to the Minzo Pass podcast for about a month now and just learning so much. And
mhm,
I heard on the podcast that you did a challenge. I reached out to you because I knew I needed just a little more face-to-face time. That's how I
mhm,
learn. I learn from someone explaining things to me and answering my questions and giving me examples one-on-one almost in a sense or in a small group setting. So I was really
mhm.
excited for the challenge and learning a lot already in day one, definitely. So ready for the rest of it.
All right, that's good. So yeah, for the challenge, so uh, we have something very innovative. We just started this again because we know a lot of people have no problem with money, right? So initially the challenge was going to be $150, but we know most people can't just come out with $150 like that. So what we have a membership portal, and with that membership, even though you enroll in the challenge, is for now is $29.97, but that one-time payment also gives you access to our membership portal, our pre-licensing membership portal. So in addition to the challenge, you will have other training there. You also have the opportunity to interact, with other students from across the country, make friends. So it feels like it gives you that sense of um, community where you don't feel like, because most of the time when you're studying, you're just by yourself, you feel like you're alone, you're in a silo, but you have that support community, and we have tons of stuff. When you finish your licensing, when you pass your exam and you get your license, they'll have another part of the community. It's called the Growth Academy. So that's for new agents because the insurance industry is very good. I tell people it's probably one of the best industries, but a lot of new agents don't succeed. And the reason they don't succeed is because they come with high expectations, and at the end, when they get their license, they go and talk to their mom. Mom, you want to buy insurance? No. Dad, no. Auntie, uncle, sister, brother, best friend. Nobody wants to buy insurance from you. After a couple of months, 6 months, 9 months, you get frustrated, you can't make any sales. Your friends start to ignore you. People start to avoid your calls because they think you're coming to sell them insurance. And after a while, after a while, people get frustrated, they get discouraged and quit, right? So 85% of new agents quit altogether within your first 1 year. So how do you make sure that that doesn't happen to you? Because there are 5 to 10% of agents that do very well in the insurance industry and they make six figures. But how do you become one of those 5 to 10%? like getting, how to get leads, turn those leads into clients, scale your business, all of those things. So we have the Growth Academy. It's for new agents. So that $29 is a recurring membership, but that gives you access to all of our training programs. So from when you enroll for the pre-licensing all the way to after you get your license, we help to train you at least for the first 1 year to get you off the ground so you can succeed. So the membership portal. So one change we made is starting today, we're going to be giving out a free trial. So what that means you can come and try it for free 5 days. You don't have to pay anything. I think the only thing is there'll be a $1 setup fee, just $1. That's to just test your card and make sure your card works. But you have the opportunity to try it for 5 days, see if you like it. If after 5 days you don't like it, you cancel your subscription. So it's something good. I'm excited about it, and we're trying to help as many people as possible get into the insurance industry. So that is it. So before we start, any questions from yesterday, Lexie?
Um, Not that I can think of right now, but if I have any, I'll make sure I write them down for tomorrow and the coming days.
All right. So perfect. So yesterday when we finished everything, um, we touched on, yesterday we started with test taking strategies, because I tell people with everything, you want to know the strategies because you can know the material, but if you don't know the test taking strategies, you're still going to fail. So you need both. So we started with the test taking strategies. We cover all 10 test taking strategies, and then we started with types of insurance, and we talked about term. We finished on term insurance, and then we talked about um, permanent insurance. So today we're going to start off. We're going to resume from permanent insurance. But what I like to do is I like to make sure that you understood it, right? Because most of the time I'm doing the talking, and people think they understand, but they don't. So I gave you assignment, and you were able to uh, complete most of it, even though you didn't do the final exam, but that's fine. So,
Oh, I'm sorry. I thought that was after we had our lesson, then I go in and do the exam.
oh, no,
I
no, no,
missed
no.
that.
Yeah. So, okay. Well, I'm sorry, I didn't explain. So it's the entire chapter one. So you're
Okay.
going to do the final exam, everything, and yes, you probably feel that's okay.
Yeah.
But now when I finish everything explaining, then you're going to go back and do all of those things, right? So now,
Okay.
we do that for two reasons. Number one, for you to see your progress, because your scores will definitely increase. But the other thing too that helps with your learning, it helps you to retain the material. So you do it on your own, you make all the mistakes, you get frustrated. Oh my God, how am I feeling this? Oh man, this is, I come and explain it, you go back and it sticks in your brain. So
Exactly. The
yeah,
process.
so that's how it goes. So we're going to go over some of those things.
Okay.
Everything you did, we're going to go over. We're going to move at a faster pace today, because
Okay.
this is the second day and we have a lot of material to go. So I'm not going to go through every single thing, because, as I said, this is a challenge. We have our boot camp. Now, the boot camp will go at a slower pace. But it's for 3 weeks. So go at a slower pace, and we'll cover state law in the boot camp. Here, we don't cover state law. It's just the general portion.
Okay.
So, um, so, so before we can begin, I'd like to recap. Tell me in your own words, without looking at your notes, okay? You shouldn't get tempted. Without looking at your notes, tell me what are the test taking strategies that you, based on what we said yesterday, you will implement to make sure you pass your exam.
Okay. So you had mentioned you mean studying strategies or
Mhm.
okay.
But
You had
everything, starting
mentioned
with test taking.
yeah.
Yeah.
You had mentioned setting a time a day, kind of like if you went into a 9 to 5. This is
Mhm.
the time that you're going to study. This is the number of hours you're going to allocate every
Mhm.
day at this from this time to this time.
Mm-hmm.
So I think that's really impressive and smart. I remember you also mentioned listening to the classical music while you study as well. Otherwise, it'll eliminate any other distractions and noise distractions, and the lights go somewhere that's really quiet,
Mm-hmm.
and peaceful. If that's what works for you.
Mm-hmm.
Um, oh gosh, what else was there? I know quizzes. You said just take quizzes, as many practice quizzes as possible, even if you're frustrated the whole time and you have no idea and you're guessing. Just continue taking them, continue looking at the answer feedback that
Mm-hmm.
explains why the answer is what it is,
Mm-hmm.
and just go back and try it again.
Mm-hmm.
Um, what else was there? Accountability partner, which you were my accountability partner for
Mm-hmm.
sure. So just have somebody who's going to be on top of you if you're wasting time watching TV, or they see you're active on Instagram. They need
Mm-hmm.
to push you to say, "Hey, what are you doing? Have you studied today? What did you do today? How did your studying go?" And just get you to really push yourself. And then I also remember you said to set the test date or at most 3 weeks ahead, preferably before then, because
Good.
otherwise you're just not going to have the fire underneath you to study, because you have your money on the line. You have to be take the test at this date. You're just gonna lollygag and take your
Mm-hmm.
time and find other things that are important. If you
True.
don't have the set date coming up pretty
True.
soon. That's all
True.
I can remember right now.
Okay, that's good. And I'll just add to what you said. Again, everything you said is right. So the other test taking strategies, make sure the day of the exam, you get at least 7 hours of sleep. Don't pull an all-nighter, because if you do, you're gonna fail. And
Yes,
then
that's so true.
yeah, you don't want to do that. And then you want to practice time management while you're studying with our simulated exams. Do not spend more than 1 minute on each question. And even while you're taking your exam, doing the actual exam, don't spend more than 1 minute. If you don't know it after 1 minute, guess and move on. And during the exam, when you know if you choose an answer, don't go back and change it, because most of the time people change from the right answer. They change from the right answer to the wrong answer. So those are some things. There were 10. Again, go back to your notes and go over all of that. And we'll talk about the active learning strategy that we use. So you test yourself first and then you go and study. Okay, that's good. Next thing I want you to summarize. I want you to summarize again what's the difference between term and permanent insurance in your own words. Give me some examples.
Okay. So term insurance is going to be less expensive than permanent,
True.
because it's more as if you are renting versus
Mhm,
owning.
mhm,
Um, there's increasing level and decreasing term options.
mhm. True.
The increasing term the allows you, when you pass away or you die, your beneficiaries receive all of those premium payments that you made throughout your lifetime plus the death
Mhm,
benefit.
mhm,
The level is more focused on group policies. So a lot of employers, I believe, do the level term insurance.
mhm,
And then decreasing is usually used in terms of protecting any loan that you've taken out, say a mortgage. So if
mhm,
you wanted to ensure that your family didn't have to worry about mortgage payments,
mhm,
you can take a decreasing term policy out so that if you did pass away, it would pay for the rest of those mortgage payments.
mhm,
And they also ensure it lowers as you make payments, because your mortgage is lowering, or your what's due is
mhm,
lowering, what's owed is lowering. So
mhm,
once it's all paid off, there's nothing left to it with the decreasing. And then with the permanent, that is more as if you own the policy for your
mhm,
entire life or until age 100. That's when it'll mature. It's a form of equity. You
mhm.
can take money out of it. You can, oh gosh,
That's
cash
okay.
surrender value. Remember cash
Mhm,
surrender value. And that is kind of, so the cash value is like your savings account, but the cash surrender value is really what you have access to at that time.
Okay.
Does it accrue interest?
Yes, yes.
So it
Mhm.
can, it can increase,
Yes.
because it's accruing interest. So you don't
Mhm.
necessarily have access to the whole savings account because they do need some of that to be accruing interest. But
Mhm.
have access to the cash surrender value,
Mhm.
minus some fees,
Mhm.
and that's pretty much what I remember.
Okay. Hey, so far, so good. Again, that's why I tell people if you can explain it in your own words, it may not be by the book, but if you can explain it in your own words, that tells me that you understand it. Because here's the thing: when you go and take the exam, once you understand the concept very well, it does not matter how they twist and turn the question, you are still going to get it right. So what I focus on is, some exam providers just get you to memorize, but it doesn't make sense because you may practice 50 questions, but none of those questions may appear on the exam, right? They won't appear word for word, but the concept will appear. So once you understand the core concepts and term and permanent insurance, 100% guarantee will be on your exam. So once you understand the core concepts, it doesn't matter how they twist and turn it, you're still going to get the questions right. So that is it. Okay. So
I do
now,
remember one more portion too. It's
oh,
important, I
yeah,
think.
sure, sure. Go
With
ahead.
term insurance, your premiums will go up every
Yes.
year. Versus
Mm-hmm,
permanent insurance, it's a fixed premium,
mm-hmm.
so you don't necessarily need to worry about the number ever changing from when you apply.
Yes. Yes.
Okay,
You,
I know that's
you're
very
right.
important.
Yeah, you're right. Now, for term insurance, with the different types, increasing, decreasing, level, what what changes? What changes? Is it the premium? Is it the death benefit? What changes?
For term insurance,
Hmm.
for so it'd be your death benefit changes because your
Perfect.
premium is fixed.
The premium, no matter what type of term insurance, again, there are three main types, right? Increasing, decreasing level. So no matter the type of term insurance, your premium will always be fixed, right? If it's for 10 years, you're paying $50 a month, it will be $50 a month for the entire 10 years. But what will change if it's increasing, your death benefit will increase. If it's decreasing, your death benefit will decrease. So the death benefit is the only thing that changes. If it's level, of course, your death benefit will remain constant. So the only thing that changes is the death benefit. The premium stays the same. So that's a key concept for you to know. Okay.
Okay.
So now let's get started. I have my document camera, so I'm going to be writing some stuff because when I teach, instead of just explaining, I like to draw diagrams and write so you can be able to see visually. So just give me 1 minute. Let me
Yeah, no
grab a
problem.
pen and I'll be right back. All right. You know what? Let me. My pen, my pen just stopped stopped working. Just give me 1 more minute.
Okay.
Let me see if I can pause this recording instead of
Okay. I'm gonna use the restroom then at the same time.
okay, that's fine.
Okay.
All right. I'm back. How to get some kind of pen over there. All right. So let's get started. So we're going according to your, we're going to according to the general insurance outline. So let's see. Let's see here. Let's see. So come here, South Carolina, exam outline. So as I said yesterday, your exam is divided into two parts. You have the state law and you have the general insurance portion. So the way it works for most states, the general insurance portion will make up anywhere between 60 to 75. I'll say about 60 to 80% of your exam will be the general insurance concept. So that was put together by the National Association of Insurance Commissioners across all 50 states. So that will be the same concept. Most of them will be tested across all 50 states. So whether you take the California exam, you're going to see those general concepts like, what is term insurance, what is whole life, like those are the general insurance concepts that will be on all 50 states exam. So once you know the general insurance, that makes up at least 60%. It could be even up to 80% of the exam. Then the state law is what's unique. It's unique to each state. So each state has different insurance laws. So those ones make up between 20 to 40% of the exam. So what you got to know is the general portion makes up the majority of the exam. So what we do for the challenge is we're just going to focus on the general portion. And then if you want the state law portion, you can take our self-study course or you can enroll in our boot camp. All right. So let me share my screen here. Let's see here. Let's do entire screen. All right. So you see my screen?
Yes.
Okay, perfect. All right. So right now we're on we're on general on types of policies. So we kind of jumped to see, we talked about term, we talked about return of premium, annually renewable, all of that. While we're still on term insurance, there are two other things I forgot to talk about term insurance. We have two special features of term insurance, and those features are renewable and convertible. What does that mean? As I said, the bad thing about term insurance is when you go to renew, right? You may be in good health now and you got a 10-year term. Let's say, but God forbid, you have a stroke, right? Or you have cancer, whatever within those 10 years. Now you go to renew your term insurance and the insurance company tells you, you're in good health when you apply, but you want to go and renew. I'm sorry. You don't qualify, right? So that is one disadvantage of term insurance. Whereas permanent insurance is like, again, it's like you own a house. So you can have good credit now. You buy that house and your credit can be whack for the rest of your life. You have no worries, right? But if you're renting a house, let's say you get a 2-year lease, you're renting an apartment, you have good credit, but let's say within those 2 years, something happens, you lose your job, you go into debt, all of that. Now you get out and you want to go and rent a new place. Now they run your credit, be like, Lexie, I'm sorry, you don't qualify, right? So that's the advantage, disadvantage of renting, because every time you go to get a new apartment, they have to run your credit, your income, all of that stuff. So you may qualify for an apartment today, but 2-3 years later, you may not qualify for an apartment. Whereas if you own a house, you buy a house, that is it. You don't have to worry about when to renew or stuff. So it's the same thing with term. So anytime you go to renew your term insurance, the insurance company think about the same way when someone wants to rent to you, a landlord wants to rent to you, the first thing they look at, the most important thing is your credit. Because they look at, oh, if this person has a bad credit score, chances are they're probably not going to pay the rent, right? So I probably don't want that person. So insurance companies, just like your credit, what they look at, the most important thing is your health. So if you are in poor health, you're a risk to the insurance company because they look like, this person has stage 4 cancer. If I insure them, they're probably not going to live long enough, and I'm going to end up losing because the way it works is the longer you keep your insurance, the more money the insurance company makes, the better off it is for them. The sooner you die, it's a loss for them, it's a win for your family, right? So the insurance company want to get people who, at least are not at risk of immediate death, right?
Mhm.
Because the longer you live, the more money they can make off you. So that's why they look at your health. Like like I just had a client, that was just denied, and it was not even because she had any disease or illness, but she was morbidly obese. She's 5'2", and she's like 260 pounds.
Mhm.
So the insurance company, deny her, right? Because it's a risk, to them. So so what's the way to prevent that? So what some insurance companies start to do, like, okay, yeah, to avoid that, I could get a permanent insurance. But what if I can't afford permanent insurance? Because as I said, permanent insurance is way more expensive than term insurance. So, like, I just ran an illustration for a 62-year-old guy. He lives in Pennsylvania, for a 30-year, no, 25-year term, for 125,000, it cost him $226. But if that was a permanent insurance, it will cost him almost $600. So you see,
Wow.
yeah. So there's a big difference. So the way insurance companies took care of that, they say, okay, we're going to add a special feature to term insurance that's called renewability. So that means when it comes time, you can renew that term insurance without us having to check your health to see whether you got health issues or stuff. So it's almost like guaranteed coverage. Once you add that feature to your term insurance, yes, your premium will increase every time you go to renew, your term insurance. Your premium will always increase, but you know that it's guaranteed that your term insurance will be renewed no matter what happens with your health. So that's
Okay.
the. You have a question, or you want to say something?
So you don't have to take a medical exam.
Exactly.
Okay.
Exactly. Yeah. So
I'm
that's
making
called,
notes.
yeah, and that's called um, renewal, right? So
Okay.
it would be called a renewable term insurance. So no, anytime you add anything extra, okay. So let's just say you have all term insurance will, all of them will pay death benefit if you die, all of that. So you have the standard policy. But anytime you add anything extra to it, it can be a rider, it can be an extra feature. Anytime you add anything extra, it's always going to cost you more. So your premium will always be higher. So if you have a renewable term insurance, it's going to cost more than someone who just has a regular term insurance. Okay. So just again, know that anytime you add anything to your insurance, it can be a term, permanent insurance. Anytime you add extra features to your insurance, is going to always increase your premium. So think about that as like you drive through McDonald's, say, I want to supersize, want to supersize my meal, right? Give me
Yeah.
all the extras. Yeah. So if you supersize, it's going to cost you extra, right? So
Right.
that's the renewable, that's renewable term. Then the other feature of term insurance we have is the convertible term. What that means. So we know life is not stagnant, right? Now things change. You may be broke today, but tomorrow your financial situation improves. So what if you can only afford term now, but let's say 5 years from now you can afford um, a permanent insurance like that client uh, that I talked about. I signed him up for a 25-year no convertible term insurance. So that means he can convert that to a permanent policy anytime within those 25 years because he's a business owner and he believes his business will get to a point in the next 5 years where he can be able to afford premiums for a permanent policy. So, so it gives you the option to convert your term insurance to a permanent insurance policy without having to prove, that you are insurable, without having to prove you're in good health. It's guaranteed convertibility. Sometimes they'll put a time limit on it, like you have to convert within the first 5 years or the first 10 years, but it gives you the option to convert. Under normal circumstance, you cannot convert your term policy to a permanent policy, but if you have that feature added to your term, then you can be able to convert from your term to your permanent policy. And no, again, because that's an extra feature, it's going to cost more. Any questions?
So if they're doing like a 10-year convertible term, it
Mhm.
has to be within those 10 years or after 10
Exactly.
years? Okay.
Within the 10 years. Yeah.
Okay.
So most of the time, they'll give you a window where you can convert that.
Okay. Got it.
All right.
But
So
if you go past the 10 years, you never converted it, you're
uh,
done?
exactly. So
Okay.
yeah. So once you go past this 10 years, then there's no way for you to convert. So you have to get a new policy.
Okay.
All right. And I just, again, as I said, for those of you who didn't listen to the day one challenge. So as I said, I'm not just teaching you theory, but I'm a full-time insurance agent. So I did a policy for this lady. Uh, it was during COVID. I think it was 2021. She was unemployed. I did a term policy, but it was a convertible term. Now she just got a job paying her 250,000. She's like, because I have money I can afford because we ran the illustration for the term because she's in her 50s. The permanent policy was going to cost her 1,500 a month, whereas the term was just I think it was like $340. So she called me up a few months ago, Dico, I can afford term. I'm like, hold on, can you afford 1,500? She's like, I'm not even going to do 1,500. I'm going to do 2,000 a month. But for
Wow.
real, she's like, yeah. So she shared the good news with me. She got a very good IT job, and she's making 200 and something thousand a year. So we're able to convert that to her. For her. So as an agent, besides, I mean, this is not for exam purposes, but I like to throw in a little bit of field training. As an agent, a lot of agents just want to sell your clients permanent policy because you want to make more, commission on permanent policy, but don't do that. Give them what they can afford, and most people, their income will increase at some point, then they can convert it over. So that
Awesome.
is it. Yeah. All right. So let's go down. Any questions on term insurance so far?
No, that
All
makes
right.
sense.
All right. So now next thing we're going to go to is we say permanent insurance policies. So let me share my document camera.
I'm gonna try to go
Mhm.
into this with my computer just because I can't see your document that big on my phone.
Okay,
But
that's
I'll just
fine.
mute my computer and my camera. Oh,
Okay, that's fine.
sorry.
That's fine.
Let me turn all this off. Hold on. Okay, there's the echo should be gone now.
Okay.
Let me
Let me share my
see.
screen so you can see.
Okay, yeah, that's helpful for me because I couldn't see you before.
Okay, so you can see my screen now, right?
Yes.
All right. So you have permanent insurance. Oh God, my pen. Come on, I just got a new one and it's doing this. What? What is going on? Wow. All right. I
Always
was
happens that way.
yeah, I don't know what happened. Okay. Well, I'll just explain. I was going to write some stuff down, but that's fine. I don't know where's that from, but all right. All right. So you can just take note. So you have different types of permanent insurance policies. The first permanent insurance policy that came on the market was whole life, right? So you have whole life. And, under whole life, you have different types of whole life. You have um, ordinary whole life. Another name for ordinary whole life. Again, it's good to know all these single names because they may not, um, they may, they won't just give you one name, they may use a different name, right? So another name for ordinary whole life is straight life, right? Straight life, um, whole life. Or, no, it will be straight whole life. Um, you have ordinary whole life. Another name is traditional whole life. So all of those mean the same. Ordinary whole life, straight whole life, traditional whole life. They all mean the same. So that's one type of whole life. The other type of whole life, you have limited pay whole life, right? You have limited pay whole life. Um, then you also have interest sensitive whole life. Again, I won't. Yeah, I'll talk a little bit maybe about interest sensitive whole life. Then you have variable whole life, right? Um, so those are the four major types. I mean, there are I think about six or seven, but
Mhm.
for your purposes, for the state of South Carolina, uh, the only ones you need to know will be the interest sensitive, the variable whole life, limited pay, and the traditional whole life. So now, so that is a whole life. I'll come back and explain all of those. That's a whole life. Then the other type of permanent insurance policy, they're called universal um, life insurance policies, right? So universal. So so under universal, and that's why I wanted to have my pen so I could show you like, okay, you have universal, then you have the arrow coming down. It makes it easy to see. But under universal, you have two major types, right? You have variable universal, right? Variable universal life, and you have index universal life. Okay, so well, it's actually three. You have the regular universal life, then you got the variable universal life, and then you have index universal life. Okay,
Okay.
all right. So those are the so for permanent insurance policies, those are the major ones. So now I'll go and explain what's the difference, right? All of that. Again, you did the questions yesterday. I'm assuming you watch most of those videos or some, so you have an idea. So let's come back to whole life. So as I said, whole life is the oldest, and because it's the oldest, it was the first permanent life insurance policy. Because it's the oldest, it's the most common, it's the
Okay.
most popular. That's why when people think life insurance, most of the time the mind goes to whole life, right? So when you become an agent, you try to tell people, show people another thing like maybe universal life. They say, "Oh, is it soul life?" No, it's completely different. So there are some key features with whole life that you need to know. But before I come to whole life, under permanent insurance, you actually have two general categories under permanent insurance. You have your fixed life insurance, okay, FIXED, fixed life insurance, and you have your variable life insurance, variable fixed. Okay, so let me explain all of that. And whole life can also go on a variable, it can go on a fixed. Universal life can go on a variable, it can go on a fixed. So let me explain the difference. So fixed life insurance, it means your premiums are fixed, your death benefit is fixed, Again, these are key features. Your the other thing to know is that the insurance company bears the investment risk because we say with permanent insurance, some of that premium you pay between 50 to 70% of your premium you pay will actually go into your savings account. So that's the advantage of permanent insurance. You're not just paying and wait to die for someone to come and take the money, right? You can actually put it in savings account where you can have access to while you're alive. So about 50 to 70% of your premium for permanent insurance goes into the savings account that you can use, at a later date. So for fixed insurance policies, the insurance company, and what is another name for insurance company?
The insurer.
Perfect, insurer. So most of the time on your exam, they're not going to use insurance company, they're going to use insurer. So those are just names to use. Or what's another name for insurance company? Yeah, there are three.
Oh gosh. Okay. Insurance company, insurer,
And then there's one more.
not the reinsurer. That's something into
Okay. Another name for insurance for insurer is principal.
oh, principal. Oh, okay.
Mhm. Okay, like almost like think about the agency model, right? When you have a real estate agent, you have your principal, which is
Mhm.
your broker. Yeah, so it's the same way. Okay,
Okay.
so yeah, so those are the three names of insurance company. So the insurance company bears the investment risks. So they will give you an agreed upon interest. Again, the advantage of permanent life insurance is not only do you have a savings account, but it actually gives you some minimum interest rate. Again, it varies from companies to companies. Some companies will give 1%, some will give 2%. It doesn't matter, but it gives you some minimum interest rate where your money can go. So now the insurance company will take a portion of that money, invest it, and then they'll give you a fixed interest rate. So you do not care whether the insurance company, whether they gain money, they lose, whether they lose money in that investment. You don't care. I mean, um, just give me my 1%, my 2%, my 5%. Just give me my interest. You promise. I don't care what you do. It's up to you, right? So the insurance company is the one taking the investment risk. So that is fixed. The interest rate for fixed insurance policies usually tend to be lower than variable insurance policies. So the interest rate you earn on average tend to be lower. Okay. Any questions so far?
No.
Okay. The other thing with fixed insurance policies, you as the policy owner, you don't have a say in how the insurance company invests your money.
Okay.
Okay, you have no say. Like you just pay your premiums. They will figure out whether they want to invest it in Apple or Amazon stock or real estate. You don't care. They decide. All you care about is just give him an interest you promised. So that is fixed. Now, let's so the easiest way to think about this is just learn one very well, and then just know that variable will be the exact opposite, right? Or you know variable very well and know fix the mirror images of each other. So one will just be the exact opposite of the other. So let's come with variable. With variable, it gives you that flexibility. So your premium payments may be flexible. Your your interest, the interest you earn, and that's the main reason it's called variable, right? The interest you earn is variable. It's almost like you get a mortgage. You can either get a fixed mortgage or you can get a variable mortgage, right? So that
Mhm.
means your interest rate will fluctuate. So it's the same thing with variable. Your interest rate is going to fluctuate, and it's going to be based on the stock market condition. So most of the time it's linked to the S&P 500. So let's say the S&P 500 does very well this month, maybe it goes up 30%. Boo, man, you will be smiling, right? Because now your account value just went up 30%. But on the flip side, if the market drops 20, 50%, boy, you just lost a lot of money.
Yeah.
So yeah, so that's it with variable. So your interest rates can go up, it can go down based on market condition. The other thing is the death benefit can also increase or it can decrease based on market conditions. Okay,
Okay.
and that's variable. The other key thing is that now you, the you as the policy holder, another name for policy holder is policy owner. So you as the policy owner, you are bearing the investment risks because say the insurance company will tell you, okay, Lexi, you have a variable product. You tell us where you want us to invest it. Most of the time they'll give you options. Okay, um, although most people never even consider it, but they'll give you the option. Now you can choose where you want to invest it. Okay, so you invest it, but you're on your own. If you lose money, oh wow. If you gain money, oh wow. But it's all on you. You can lose all the money in your savings account. You think about it as like maybe um, stock account. You can invest your money, you can lose everything, you can gain a lot, you can gain a little, you can lose a little, but it's up to you. So that's variable. Now, variable also has two accounts. Two accounts. It has a general account and it has a separate account. So on the exam, they may ask which of the following is a difference between variable and fixed. So variable, okay. So the way to think about it, anytime you think anything variable, whether it's variable annuity, variable whole life, variable universal life, anytime you hear the word variable, think interest rate fluctuates up and down. Think two. You need two of a kind, everything. And I'll explain what those two is. So once you know those two, you'll probably get about half of the variable interest and variable product questions, right? So you need two of a kind and the interest rate fluctuates. So what are the two of the kinds? Variable comes with two accounts. You have the separate account and the general account. The general account is the account that the insurance company puts, all their premiums, and that goes towards paying death benefits. It goes towards the insurance company, their expenses. Because insurance companies are like any business; they got to pay employees, they got to pay, just business expenses, right? So they have to do all of those. So everything goes into the general account, right? The general account is a safe account, right? Because the insurance company is not putting in risky investments or stuff like that. So that's the secure account. So a portion of if you have a variable insurance policy, a portion of your premium payment goes into that safe account that is there to pay death benefit and all of that. The other account is called a separate account. Separate account. And that separate account, just think about it as your investment account. Okay? So think about it as an investment account. So that is the money that now the insurance company will invest for you. So you have two accounts. So the separate account, you can lose money in the separate account because it's your money, but you're investing it, right? So for variable, the insurance company is the opposite of fixed. The insurance company is taking the risks. No, not insurance. You as the policy owner,
Yeah.
you bear the risks, right? You bear the financial risks, and you also direct the insurance company on how to manage your money. So that's the first two. The second two is you need two licenses to sell variable insurance products. Okay, you need two licenses. You need a life insurance license. It doesn't matter whether it's variable annuity, variable whole life, variable universal life. You need two licenses. You need a separate, you need a life insurance license and you need a securities license. Okay, life insurance license and you need a securities license. So those are two. Whereas for fixed, all you need is just a life insurance license. For fixed, it just has one account that your money goes into. It goes into the general account. Variable, you have two accounts, separate and general, and you need two licenses to sell it. You need fixed and securities license. Variable products are also regulated by two um, entities. Unlike fixed accounts, fixed insurance accounts, they're just regulated by the insurance department. That is it. But variable, they're also regulated at the federal level because the federal government says, people could lose their money. So the federal government wants more oversight. Like, okay, this is something that people could lose their money. In some people put a lot of money in your variable insurance products, whether it's a variable annuity or whatever life insurance. And before the federal government could step in, they found out that people were losing a lot of money. That agents were just selling these things. People really didn't understand them. So the federal government stepped in and like, no, we need more oversight. So now the reason the federal government is doing it is because it's a security product. So a security product is any kind of financial product, whether it's insurance, investment, but any kind of financial product where you as the investor have you have a chance of losing a portion or all of your money. For fixed life insurance, you don't have to worry about losing your money because like you have a guaranteed interest rate where your money can only go up, it can never come down. So you never have to worry about losing money. But security lose money. So the government say, we need these agents that will sell these products. We need them to go through extra training and extra oversight. So we will step in. So the federal government through the FINRA, 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 Financial Industry Regulatory Authority, FINRA. So the two entities that regulate variable products are your State Department of Insurance and FINRA, the Financial Industry Regulatory Authority. Any questions so far?
No. I'm just making notes here. Industry Regulatory Authority. Okay. So that's who regulates.
Variable products.
Okay. Perfect.
Okay. So now, on your exam, maybe throw in SEC also, right? Securities and Exchange Commission. So if you just have FINRA and State Department, if you have FINRA and your State Department of Insurance, that's the correct answer. Sometimes they'll throw in the SEC, then it will be all three. The SEC also regulates security products, right? So yeah, so it's going to be three, but FINRA is the primary one. Okay.
Okay.
All right. Any questions so far?
No.
Okay. Again, if you don't have questions for me, I'll have questions for you because at the end, I'm going to ask you now to come and explain. If not today, maybe tomorrow, I'll come and ask you to explain all these things. Okay.
Okay.
So yeah, so that is so we'll cover the two general categories of permanent insurance: fixed versus variable. Okay. Now let's come down to the fixed, right? So under the fixed, you have, of course, variable whole life also has whole life has a fixed and a variable component. But let's come to variable. Let's come to the fixed. So you have ordinary whole life. Ordinary whole life is the first type of whole life. Another name for it again is
straight and continuous.
Yes, straight continuous. That's another name. Yep, continuous is another name. Another name is traditional whole life. So for that one, your premium payment is fixed. Your death benefit is fixed. Okay, so two things: your premium payments are fixed. Your death benefit is fixed. The key thing for whole life products to know that your death benefit cannot be changed. Okay.
Okay.
So your death benefit is fixed. So let's say You get a policy 3 years later, you say, oh, I want to increase my death benefit. No, it's not. Oh, no, no, it's fixed. All right.
Okay.
Now, so that is traditional. So traditional whole life, you pay your premium, like, most permanent life insurance policies, you pay your premium for life, right? When they say for life, let's say up until age 100. No. So you pay your premiums either until you die or up until age 100. So it's for life, premium payments for life. Then you have another one that's called limited pay. Limited pay is just what it means. So your coverage is still for life, but your payment um, um, duration is limited. So a good example for that, because I think most people can understand this. Most people either have a house or they know somebody who owns a house. So with the way limited pay works, just think about paying off your house early, right? So the mortgage company may say you have 30 years to pay off your mortgage. Okay, but I mean, I have money. I want to pay off my house in 5 years, in 10 years. So if I want to pay off early, I should be able to pay off early, right? So think about limited pay as you paying off your life insurance early. So again, as I said, life insurance, the way they schedule the premium payments, that is to last until age 100. But you can say, I want a 10-year limited pay. So that means something you're supposed to pay over the course of 100 years, or not 100, but let's say you're 30 years old, so 70 years.
Yeah.
No, but something you're supposed to pay over the course of your life, now you pay off in 10 years. So one thing to know is the premium for limited pay whole life will always, not sometimes, will always be higher than ordinary whole life. Because why? You're condensing
Mm-hmm.
the payment period, right? So of course it's going to be higher. Okay, so the payment will always be higher, but your coverage will still be the same. It's still for life.
Okay.
Okay, so that's limited pay. The other type of whole life that will be on your exam is called single premium whole life. So if you're rich, hey, if let's say you're Bill Gates or Oprah Winfrey, you don't need to do monthly mortgage payment, right? Nah, just write a check, one-time check, and just pay off, right? That is a single premium. So just think about it as writing one-time check, making one payment and it's paid off. So you don't have to worry about monthly payments or paying for years or stuff like that. So that's single premium. Now, on your exam, and I'm sure you saw this in our practice questions, they're going to ask you which one of these has, which one of the following policies has um, the highest total premium. A, ordinary whole life. B, limited pay whole life. C, single premium whole life. D, none of the above. What would be the answer?
Would be the single premium because it's
Well,
one lump sum.
no, 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 no.
Has the highest or there. I guess there's no premium in a single premium if you're only paying it once.
No, and that's where
They
people
trick
get
you.
tricked. They say which one has the total. The key
So
word is total.
so
Total.
limited.
Hmm. Uh, no.
Oh wait, I'm sorry.
Okay,
No,
so
but it's ordinary. It's the ordinary because you're paying so many years.
I'll just give you an example.
Okay.
If you if you if you go to a store, let's say you want to buy a TV, right? Like you want to buy a flat screen. Back in the days when flat screen TV just came out, it was very expensive, right? So most people couldn't afford to pay for it upfront. They had to make like payment arrangement, pay off and stuff like that. So let's say you have three options for that flat screen TV. Option one, you can just whip up your credit card and just pay one time. But if you can afford it, then the seller tells you, oh, Lexie, you know what, you can pay this over in 12 months. But guess what? The seller is going to add some
Interest.
extra, yeah, interest, extra payment, right? Because hey, you're paying it off over a longer period of time, right? So they have to add extra fee, the processing fee, and all of that stuff, right? To all. So let's just make it easy. Let's say the TV was $1,000. So if you just swipe your card one time, pay for it one time, you pay 1,000. But now if you pay what 12, they say, okay, maybe you pay $100 a month every month for 12 months. So that's 1,200, right? So now
Mhm.
doing if you're paying it off over 12 months, you end up paying $200 more than the person who paid 1,000. But let's just, for argument's sake, say like you can't afford that $100 a month. You can only afford $50 a month. So now let's say okay, you can pay over. They will never tell you 3 years because 3 years sounds too bad. They'll say you could just pay in 36 months. So maybe you can pay $60 every month for 36 months. And that's where they get you. When you do the interest payment, when you do the math, you end up paying almost $400 extra. So
Mhm.
among those three people who will end up paying the total amount, who will end up paying
Right.
more. Like
The the last
the
one, the ordinary.
yes. So the person so just know that the longer your payment,
Mhm.
the more your total premium will be because the insurance company has something called cost of insurance. So every time you send in your premiums to the insurance, they need to pay someone to process it, right? They need
Mhm.
to pay the accountant, they need to pay someone to go to the mail to, or if you're doing electronic payment, they have to pay someone to go and check the account. So like every time you send in your payments, it's costing the insurance company money because they need people to log that all of that in, right? So the insurance
Right.
company is going to add extra to it, something called the cost of insurance. So when I run illustration for clients, sometimes I'll run, just for them to understand how it works, I'll run illustration like if they have money for them to just pay one time or maybe pay off in 7 years versus just pay for the rest of their life. And always the people who want to pay the monthly payment for the rest of those people, their total premium is always higher than people who can pay in 4 years or 10 years or stuff like that. So the key there is total. If they ask which of these would pay the highest premium, of course it's single premium. But if they
Right.
if they ask the total, you're
Mhm.
taking all the premium payments, it will be the person who pays the longest.
Okay, that makes
Mm,
sense. Yeah, the
mm,
total tricked
yeah,
me.
yes, total. All right. So that is
Okay.
it for. So we just talked about limited pay, we talked about ordinary, and we talked about single premium. Now we're still on variable, we're still on whole life. Now let's come to variable whole life. So it will be everything will be the same with just some few differences. So you have all the features of variable insurance products. So you need two licenses to sell it, a securities license and a life insurance license. You need two accounts. You need a general account. The insurance company will have a general account and a separate account. You're going to need the policy owner will bear the investment risks. They
Mhm.
will direct the investment how they want it to go, right? For variable whole life, it comes with a minimum guaranteed death benefit. Why the insurance company say, okay, you know what? Yeah, even though your death benefit could go up and down, but we want to give you some guaranteed minimum death benefit that no matter what, your death benefit will not fall below a certain level, right? So know that with variable, it gives you a guaranteed minimum death benefit. So when you see guaranteed minimum death benefit and fixed premium, that's the key. Fixed premium. Anytime you see fixed premium and fixed death benefit, you know it's variable. If you see fixed premium and guarantee minimum death benefits, because the only time you guarantee something is you know that it can go up or flip. So you have guaranteed minimum death benefit and fixed premium, you know it's variable whole life.
Okay.
Any questions?
Um, so if the premium is fixed though, that's just fixed, right? Whole
Yeah,
life?
so yeah, so one of the
It's
key,
that the premium is flexible.
yes. So and we'll get to flexible premium. But one of the key things with variable whole with whole life, regular whole life is the premium is fixed.
Okay.
The
Right. Okay.
premium, yeah, the premium is fixed. And the
Got it.
death benefit is fixed, yeah.
Okay. Okay. Got it.
But with variable whole life, your death benefit can increase,
Mm-hmm.
you know, but it won't go below a certain level.
Okay.
Okay. All
Perfect.
right. So now that's variable. Now let's get to the next type of permanent insurance policy is universal life. So again, on your exam, you're not going to be able to know every single thing, right? It's
Mm-hmm.
impossible because it's a lot of material. But we'll kind of use some tricks to help you. Like you can associate some, you can associate keywords and some things with certain concepts. So by the time you see that, boom, like an alarm goes off in your head. So just know that for universal life insurance policy, anytime you see universal, think flexible. Think
Okay.
flexibility. So flexible premium, flexible death benefit. Variable, um, whole life, again, regular whole life is fixed death benefit, fixed premium. Universal would just be the opposite. It's flexible death benefit and flexible premium. What does that mean? That means you can increase your death benefits, you can decrease your death benefits, right? Usually for universal policies, they'll ask you to wait at least 3 years. But after 3 years, you can be able to say, hey, you know what? I want to increase my death benefit, so you can increase it. After 3 years, you can decrease it. That is fine, right? You can also increase, you can also decrease your premium. So variable, universal, anytime you think universal, think flexibility
Mm-hmm.
because the reason they came up, so as I said, whole life was the first, but a lot of people started to complain like they felt it was too rigid. Like, come on. So, we know life changes. You may be making good money today, tomorrow you're not making money. So, people should have the option to make changes. I want to, or maybe you may be single today and you get that life insurance. But let's say 5 years later, you have a family, you have 5 kids, so you need more coverage, right? So instead of having to go and buy a new life insurance policy, why can't I just increase the death benefit, right?
Mm-hmm.
So people understand that life changes. So whole life was very rigid. So that's where universal life insurance, came in.
Okay.
So you can increase your death benefit, you can decrease it, you can increase your premium, you can decrease it also. Now, under universal life, know that universal life comes with two death benefit options. So very important. It's the only life insurance that comes with two death benefit options. It doesn't matter whether it's variable universal, index universal, regular universal, it doesn't matter, right? So we said hallmark number one for universal policies is flexibility. Flexible premiums, flexible death benefit. The second thing, it comes with two death benefit options. And that's one of the advantages it has over whole life. What does that mean? Death benefit option A, that means your death benefit is, they'll just give you what you sign up for. So if you have a $500,000 policy, when you die, your family gets 500,000. That's it. Option B, um, some people started to complain like, but hold on, what if I pay 300,000 into this policy over my lifetime and I die? I mean, would the insurance company just keep all my 300,000? I mean, that doesn't sound right. They should be able to at least give me some of that money, right? So now, option B, death benefit, asks that the death benefit will be your regular death benefit plus your cash value. So let's say You have it's a $500,000 policy, but you have 300,000 your cash value. Now, when you die, your fund will get 800,000 instead of 500,000. So that is option B, right? So universal is the only type of life insurance that has two options for death benefit, and option B is sometimes called,
What is that?
yeah, I don't know. I'm just saying that. Yeah,
That's
I don't
funny. I
know.
don't know.
Yeah, I don't know if the balloons. I don't know. But yeah, so option B is called increasing death benefit. Okay, so sometimes it's called option B, sometimes it's called increasing death benefit, but it's always good to know the synonyms of these things. So increasing death benefit, that just means you're going to get the cash value plus the death benefit, and a lot of people love it. Um, Now just know that for that one, um, the your cash value is going to accrue or is going to increase at a slower rate than a regular level death benefit. So that's the only disadvantage of that. So you have those two options. Now we're still on universal. Then under universal, you have three types. You have the regular universal, it's just called universal life, which I mean will have two death benefit options. The client will have the option to choose, and then you have the flexible premium, flexible death benefit. Option two is called index universal life. A short form for it, the abbreviation is called IUL. For me, full disclosure, that's my favorite insurance policy. If my client can afford it, I always recommend it right now. It usually tends to be the most expensive, but as they say in life, you always get what you pay for, right?
Mm-hmm.
Cheap is not always cheap. uh,
Very true.
but it's my favorite life insurance policy itself. So with index universal life insurance policy, what that does is say, okay, index universal life insurance, it came about because people were getting their, as I said, life insurance, permanent life insurance, you get interest, right? But the interest rate was very low, whether it was whole life or stuff, the interest rate was very low. So insurance companies say, okay, we'll come up with an insurance product. It's not going to be a variable product where you could lose money because a lot of people didn't want to take that risk with their money. Say, okay, we're going to give you still a fixed product where you don't have to be at risk of losing your money, but we're going to be able to tie the performance of that, what you get, to a stock market index. So, for example, the S&P 500. So now we're going to give you a guarantee minimum, and we're going to give you a maximum. So one of the companies that sell the products will give you guarantee 1% interest rate. So no matter what, even if the stock market goes down 50, 100%, you don't care because you always get that guarantee minimum of 1% interest rate. But
Okay.
you could get up to 15% interest rate depending on how the market goes. I know the last time the market was doing very well, I think it was 2017, 2018, right? So I had clients that got 10, that consistently got 10, 12% interest every month because they are higher. Whereas if they had, let's say, a whole life policy, you're going to get maybe 3 or 4% interest, right? So IUL gives you all the advantages of the stock market,
Mm-hmm.
of course, at a cap, but without any of the disadvantages. So a lot of clients love it, and over time, the IUL even performs better than the fixed, insurance policy, than whole life, all the other insurance policies. So that's called index universal life. Why is it called index? Because it's tied to a stock market index. You have
Mm-hmm.
the S&P 500, you have the Dow Jones, all of that stuff. It's tied to a particular S&P 500 stock market index. That's why it's called index universal life insurance policy.
Okay.
So that is the main difference between the index. It gives you a guarantee minimum and it gives you a maximum. It gives you a bottom. You can't go below that bottom, and it gives you a ceiling. You can't go above that ceiling.
Okay.
Okay, so that's index universal life. Now you come to variable universal life, which is the third type. Variable universal life is um, so you have all the features of universal life again because it's a variable product. Um, you need two licenses to sell it.
Okay.
You need securities and life insurance is regulated by the State Department of Insurance and by FINRA. It comes with a separate account and a general account, and the insurance, the policy owner would bear the investment risk, right? So you would lose, a lot of your money in your cash value and all of that. So that is the only difference. Um, so that's it. Now I forgot to talk about index interest sensitive whole life. That is also on your outline.
Mm-hmm.
I forgot to talk about it. So let me touch on it quickly. So interest sensitive is just like regular whole life, but when people came up with universal life, then these companies that sold whole life, they're like, oh crap, we have to catch up. What can we do to catch up? So they came up with something called interest sensitive whole life. So what that means is that okay, they'll give you uh, an assumed interest rate. They'll say, okay, Lexie, you get this whole life policy. We assume you're going to get 5% interest rate, right?
Okay.
But let's say if the stock market does very well and we make a lot of money, then what we can do is for the next let's say the stock market, let's say your interest rate is 5%, and this year the stock market does 10%. Then next year, what we'll do, because we earn a little more money than we expected on your premiums, next month, next year, we're going to lower your premiums, right?
Okay.
So it's an inverse relationship. So think about seesaw, right? When one is down, the other one is up, just like that.
Mm-hmm.
When we used to get on seesaw. I don't know if you
No, it
you
makes
did
sense.
that
Yeah.
one. You did that one, but
Like a
so
discount for you because they're
yeah,
making money off of you.
exactly. So if the stock market does well, the next year your premiums will go down.
Okay.
But on the flip side, if the stock market does very bad, then they'll come back to you and say, Lexi, even though we say 5%, but we lost a lot of money. So I'm sorry, to make up for that, we have to increase your premiums next year.
Okay. You're like, why is that my fault?
Exactly. So you have some people who like it again.
Yeah.
They say to each his own, but that's interest sensitive for life. So what changes is your premium payment. So your premium will increase or decrease based on the performance of link stock market index. So that
Okay.
covers. Let me see here. I think that covers everything for permanent index. Yeah. So we'll cover everything for permanent. We'll cover term. We'll cover whole life. Yeah. So any questions on all of that?
And
We're go ahead.
so we're just so all the other stuff we've talked about, or I guess I would did some quizzes on like graded and modified. Is that do I not really need to know that because it's not on my outline?
Perfect. And
Well,
that
don't
and
worry,
that
I was
and that brings me
know
back.
those.
Yeah, that brings me back to our test taking strategies. So if you take our self-study course, then you don't need to worry about what is on your outline because everything that's on your outline will be it will be part of our course. In the questions, in the study guide, is going to be there. I don't want to bash our competitors, but sometimes what they do, because I understand where they're coming from because it's easier, it's less time consuming. But what they do sometimes you have the general content, as I said, all these things. So
Mm-hmm.
they'll just do one general content for all 50 states. So for example, um, how do you call it? What I'm trying, like another type of um, whole life is called graded premium, which I'm not going to get into because it's not on your exam outline, but you have graded premium. Um, Another one,
The modified. I
yeah,
studied
yeah,
all
yeah,
this
yeah,
last night.
no, that's waste of time.
Ugh,
You have modified premium, then you got graded premium whole life. That is not going to be on your exam, right?
okay, that's
That
good.
again, we wouldn't go by your exam outline. So if it's not on
Perfect.
your exam outline, it's not going to be in your course content, right?
Okay.
So again, that is what makes us different, and that's why we, as I said yesterday, the industry average pass rate is 37%.
Hmm.
37%. Ours is almost three times that is 82%. And it's that for our self-study courses. And it's that for a reason because we do things differently. So yes. So for that, we're not going to cover that because that is not graded. All
Okay.
of that is not on your exam outline. So we're going to
Fine
skip.
by me.
So that's it. So now let's go to the next insurance product is annuities.
Okay.
Annuities. So annuities, I'll just say annuities is a sibling of life insurance, but it's this ugly sibling of life insurance that nobody wants to pay attention to.
It's the
Like,
ugly symbol.
the ugly sibling of life insurance that is actually very good. Uh, no, if no, if only people could take time to understand that sibling, they'll kind of find out that that sibling is actually not bad, very good. So I like to refer to annuities as the ugly sibling of life insurance. That people don't want to be bothered with, but they should probably give a second look to. So let's talk about annuities. So we'll wrap up with annuities.
Okay.
Because today all we're doing is types of insurance policies. And then tomorrow when we come, we'll do chapter two and other ones. So annuities, I wish my pen could write, but still not writing. Oh yeah, yeah. All right. Uh, let's so annuities. Um, as I told you yesterday, I'm sorry, I don't know if you can hear, I got a background noise. Someone is doing something.
Oh, barely. It's
Yeah,
okay. It sounds
yeah,
nice, almost like a wind chime.
yeah.
That's what it sounds like to me.
Okay. So annuities will be the opposite of life insurance.
Okay.
So as you said last time, like a car, right? You have different types of cars. You have your SUV, your pickup truck. You have your minivans. You have your coupes. Different cars. They may serve different niche um, purposes, but all of them serve one overriding function, that is to transport you from point A to point B. It's the same thing with life insurance. So you have all these things, all these different life insurance policies. You have term for someone who needs temporary protection, permanent for someone who needs long-term protection, all of that. But the overriding, the main function of life insurance is to pay your death benefit when you die. That is it. All the other stuff, people can use it for retirement, people can use it for living benefits, long-term care, people can use it as a savings account. All of that, that's all good, but that is not the main purpose of life insurance. The
Hmm.
main purpose is to provide a death benefit. Flip that with annuities. The main purpose of annuity is to provide a living benefit while you're still alive. So life insurance is for when you're dead. Again, for test purposes, even though in real life, life insurance can be used for a lot of living benefits, but just for test purposes. So it's when you're there to provide income for your beneficiary. Annuities is to provide you income while you're alive. Okay. So on your exam, they may say which of the following is primarily used or mainly used for retirement. You may say A, annuities, B, term insurance, the variable whole life. Let me show some stuff there. But anytime you think annuity, again, life insurance can be used for retirement. I know people who put their retirement money in life insurance, but that is not the main use of life insurance. Annuities is the main use of annuity is to provide you income either for life or for a specified period of time. Okay, so to
Okay.
provide you retirement income. Uh, so that is the purpose for life insurance. So it's the opposite um, of that's the purpose of annuity. It's the opposite of life insurance. Life insurance is to provide a death benefit. Annuities is to provide you living benefits, and that living benefit is retirement income or income for a specified period of time. All right.
Okay.
So that is annuities. Now, for exam purposes, let's get back. Life insurance, they will say life insurance is used for, um, again, paying death benefit. That's the main thing. But other uses of life insurance can be used for estate conservation.
Mm-hmm.
So what does that mean? That's where rich people come in. So if you're rich,
Mm.
then there's something called death tax, right? And that's why people hate taxes because you're taxed when you earn the money, you're taxed when you spend the money, you're taxed when you buy property with the money or whatever, property tax, this tax, that tax, and then even when you die, you're still taxed on the money. Damn it! So
Crazy.
so there's something called estate tax, which is just a fancy name for death tax. When you pass, when you die, for your family to get that money, they have to pay taxes on it. So what some rich people do is they say, okay, I'm going to get life insurance, and the life insurance, the main use of that life insurance would just be when I die, they can take that death benefit and pay all my estate taxes. So
Mm-hmm.
now my family does not have to liquidate that to pay taxes. So it's meant to conserve, to keep, right, to maintain
Mm-hmm.
estate. So that's another use of life insurance. So it can be to conserve the life insurance. Okay, no, it's to conserve an estate.
Mm-hmm.
As we said, um, annuities is the opposite, right? So annuity will be used to liquidate an estate, okay, to get rid of. So now, let's say you get a windfall of money, you can take that money and put it into annuities, right? So annuities is to liquidate an estate, and life insurance is to conserve an estate. All right. So annuities, we said that's the main use of annuities. Now, you have different types of annuities, and it gets confusing. But the types of annuity, the names are based on what they do. So, as I said, annuity pays you benefit while you're still alive, right? Income, either for life or for a specified period of time. So, with that, the benefit payment, it can either be fixed or it can be variable. Okay, fixed or variable. We say again, variable. If it's variable, you need two accounts, two licenses, all of that, FINRA, SEC, regulate, again, everything for variable life insurance will apply to variable annuities, right? So so for two, your benefits, they can either pay you a fixed amount. Okay, so Lexie, you look like you're in your 20s, you're still young.
Not
So,
anymore.
so let's just say you get a let's say you get an annuity. And you say, okay, I want to be putting money into this when I retire in my 60s or whenever, so I can get a fixed income for life. So now your benefit payment, that is your income payment, what the insurance company will pay you, think about your retirement income, will be fixed. It's not going to go up, it's not going to go down, it's going to be fixed. So whatever it is, if it's 500 a month or 1,000 a month, it will be fixed, right?
Okay.
So for those type of annuities they're called fixed annuities. So anytime you hear fixed versus variable, just think it's about you know it's about your benefit payments, right? Fixed.
Mhm.
So your income payment is fixed. Now the other thing, fixed also refers to your interest rate. So if your interest rate is fixed, then your annuity no payment will not no uh, your annuity your annuity payment is fixed because your interest rate is fixed, right? So all of them kind of go hand. Whereas variable, your interest rate can go up, it can go down. So your benefit payments will not be fixed, right? It will be variable because this month, if your account does very well, then you will get maybe $700. Next month, if your account does poorly, you will get $200, right? So it's
Okay.
very so those are the two. Now, on the exam, they may say which of the following um, um, outpaces inflation, or one of the benefits of blank is that it outpaces inflation. A, variable annuity, um, fixed annuity. B, they'll give you some different options. So anytime you see variable, just know that one of the advantages is it actually outpaces inflation, because inflation, average inflation is around maybe 2 to 4% a year, maybe 3%. So people get, you may say, damn, but you could lose your money. Why would people get variable, right? It's the same reason people buy stocks. Yeah, I know that I invest in stocks, I could lose all my money, but I know that then I could also get lucky and make a lot of money, right? So people want huge returns. So that's why people get variable products. So variable annuities, whether it's variable life insurance, one of the advantages is the interest rate is usually higher and it's going to outpace inflation. So that's one of the advantages. So so you have fixed versus variable. So anytime you see fixed annuity, know that the benefit payment is fixed and the interest is fixed. When you see variable annuity, know that the benefit payments, the amount you receive can be variable. Why? Because your interest rate is variable, goes up and down.
Mhm.
And then for variable annuity, also your benefit payments will be calculated in accumulation units, right? So not in dollars, but anytime you see year accumulation units or year units, think about variable annuities. Okay, so those are all cues. Anytime year units, and annuity is variable
Okay.
without any exception. All
And
right.
not in dollars. Oh, but
Yeah,
fixed is in dollars.
exactly.
Okay.
All right. So the first question is, how is the benefit paid? So it can either be fixed, or it can be it can be variable. The next
Okay.
one is the next one is the premium payment, because just like life insurance, you got to pay premium, right?
Mm-hmm.
Um, so that premium is like your savings. Let's say you got 401k and you're saving 500 or 1,000 every month. So it's the same one. So your 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 payment, your premium payment can either be immediate or it can be deferred. So your year immediate annuity, deferred annuity. All that tells you is when your payment is made. So immediate annuity always is um, you're paying one premium again. That's for rich people, or not just rich people. I know one of my clients, this was a long time ago, I think 2015 or so. She got lucky. She married a rich guy, but it didn't work out. So they got divorced, and she got like $650,000 in the divorce settlement. So,
Not
so
bad.
she was my client, and she had other, I had life insurance as well. So she came to me like, oh, I got this money. I don't want to just use it. 'Cause if I keep it in my account, I'm probably going to blow it. So, can you tell me how to use it? So I recommended variable annuity. I recommended an annuity, index annuity, and she just wrote one-time check. Boom, all that money just went in. So one-time premium payment, and then she's like, "Oh, well, I don't need the money now. I'm still young. I'm working. I want to start receiving payment when I'm 50 years old." Right?
Okay.
So, uh, so, so, so that is an example of so
Def-
you can have a single premium deferred annuity, and
okay.
or you can have a single premium immediate annuity. So immediate just means I'm going to start receiving I'm going to start receiving benefits immediately. So immediate versus deferred, it just means when your benefit payments will start.
Mm-hmm.
Fixed versus variable tells you how you will receive your benefits, right? Will your benefit
Mm-hmm.
fix or go up and down? Immediate versus deferred just tells you, how you're going to, when you're going to receive your benefits. Do you receive it immediately or do you receive it deferred? Okay, so let me define what immediate. Immediate just means within 12 months. So if you get the benefit payment within 12 months, it's immediate. No, if you start receiving benefits within 12 months, it's immediate.
Mm-hmm.
If you
Okay.
start receiving benefits after 12 months, then it's called deferred, right?
Okay.
You waited more than 1 year. So for immediate annuity, what you got to know is immediate annuity is always, without exception, always paid with a single premium. Because hey, I pay $50,000 right now, and I can start my benefit payment, 30 days later or 60 days later, right? So just know immediate annuities are always no single premium. If you pay your annuity with single premium, they're always immediate annuity. Okay. No, I'm sorry. Immediate annuity are always single premium payment. That means you just pay one premium and you start getting your money right away.
Mm-hmm.
Now, you have deferred annuity. Deferred annuity means my benefit payments start after 12 months. But now you make regular premium payments, right? So you could say, okay, I'm going to make premium payments for 5 years or for 10 years. So you make regular, it can be quarterly, monthly, it doesn't matter, regular premium payments. And at a certain time, you can start to receive benefit payments. So if it's more than 12 months, it's called deferred annuity. So your benefit payments, regular, you make regular payments. So that's deferred. Now, let me get back to the beginning. So you have some terms you have to understand for annuities. There's something called accumulation, the accumulation period. The accumulation period for an annuity is to just think about is the pay-in period. It's the time where you are putting money in, right? So it can be called the accumulation period. It can be called the pay-in period. It can be called the the benefit no, it can be called investment period. No, there are so many names for it, right? But that's the period of time where you're putting money in. The next period for an annuity is called the annuitization period. That is payout period. That is when now I go from putting money in to now taking money in. That could be, that you start withdrawing money or start getting money. So another name for that is the payout period. It's called the um, 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 distribution
Annuity.
phase, right? So you have different names. So you just got to know those synonyms. You
Okay.
have, yeah, everything there. So now the process by which your annuity goes from accumulation, you putting in to now you taking out, that process is called annuitization. So when your annuity is annuitized, it means now it's switched from paying in to taking out. So annuitization. It's a
Okay.
fancy name to just means that now I switch from paying in to taking out.
Okay. So it was accumulation period is the time that you're putting the money in.
Exactly.
Annualize
Annuitization,
annualization
yeah, it's when you're
is
taking money out.
so so but okay, sorry, I'm a little confused.
Okay, that's
Because I
fine.
thought you had said that was the process of
Yes,
between putting money in and taking out, but it's
yes,
also just taking out and it's the
yes.
same thing.
So,
Okay.
okay, so you're going to hear the word annuity period.
Mm-hmm.
You want to hear the word payout period,
Okay.
distribution period, they all mean the same thing when you're
Okay.
taking money. The annuitization is the process.
Okay.
So we have the annuity phase or the payout phase, but the annuitization is the process when your annuity goes from being accumulating. That means you're putting money in now to taking money out. That's the
Okay. Got it.
yeah.
Got it. Perfect.
Okay.
Okay.
So yeah, so we have that, and then now let's talk about some key terms. We'll soon wrap up.
Mhm.
Some key terms here for annuity. We also have the annuitant. So the annuitant for all you should know is the annuitant is just the insured, right? So
Mhm.
life insurance has the insured. That's the person who the life insurance policy is based on. That's the person who has to die before death benefits are paid out. So the annuitant for annuities or is the insured, right? It's the primary insured. So the annuitant is the primary beneficiary. That's the person who is entitled to receive that income, right? Now,
Okay.
the annuitant can also be the owner of the annuity, right? So I can get an annuity for myself, and when I reach a certain age, I start taking money out. So the annuitant can be the same as the annuity holder.
Mhm.
But the annuitant can never be the same as the beneficiary because it doesn't make sense, right? The beneficiary in annuity is like the secondary beneficiary because the annuitant is the primary beneficiary. So the annuitant, so you start taking money out, and then let's say when you die, then your beneficiary will continue to take money out, right?
Okay.
Whereas for life insurance, the insured cannot take any money out while they're still alive, right? They have to wait and die before before that money goes. So again, that comes to the whole purpose for annuity is to provide living benefits, right? To provide income to the annuitant while the annuitant is still alive.
Okay.
And then for life insurance too, the insured and the beneficiary can never be the same people, no, or can never be the same person because the beneficiary has to die before the insurer has to die before the beneficiary receive money. But how are you going to be dead and receive money at the same time?
Right. Yeah. That makes perfect sense.
Yeah. So those are key terms for annuity, and then the owner of the annuity will be called the annuity owner, and then of course the secondary beneficiary, that's the person that will receive money after the annuitant dies, is called the beneficiary. Just
Okay.
key terms. What else here? Let me go back here to the outline. Just want to make sure I cover. Okay, so we cover fixed versus variable,
Variable.
cover
Mhm.
immediate versus deferred. So know that deferred annuity can either be with one-time premium payment. You can have a single premium deferred annuity. Okay, so like that client, okay, I put one lump sum, but I'm not going to start to take money out until a certain period of time, right? So you can have a single premium deferred annuity, or you can have or um, multiple premium deferred annuity, right?
Okay.
But what means the same? But that means you don't start to take money out until after 12 months. On your exam, sometimes they may say 30 days. So if it's within 30 days, it's still immediate annuity. The most correct answer is 12 months. But if you don't see 12 months there, if it tells you within 30 days, it's still immediate annuity.
Immediate.
Yeah.
Okay.
Okay. So other thing here. Um, okay. So the next one is the premium payment. So you can either pay single premium, that means
Mhm.
one-time premium. You can pay a level premium, so it can be regular premium payments that's level. Okay, I'm going to pay $500 every month for the next 20 years, right? So it's level, or the other one is adjustable or flexible premium payment. So like, okay, I'm going to just send in money as I have it. So this month I can send in $1,000. Next month I may be able to send in only 200. So it's
Okay.
flexible, right? Those are the other types here.
Okay.
And then let's see here, we'll cover that. And then okay, so for index annuity, so index annuity would be just like index universal life insurance, right? So that one, they're going to give you a, a they're going to give you a minimum and a maximum. So they'll say, okay, maybe the minimum is 5%, but you could go up to 10 or 15% depending on the market condition. So the advantage of index over fixed annuity, again, index on average will uh, give you a higher benefit payment. You will be able to get more interest and you can be able to outpace inflation. So that's the key advantage. So you have index annuity. It's linked to a stock market index. That's why it's called index annuity. So now
Okay.
let's go over payout options quickly for annuity. We're going to go over maybe 5 minutes or so, but that's okay.
Okay.
To just I just want us to finish no chapter one. Then tomorrow we can start on chapter two.
Yeah.
So you have payout options. So the payout options um, for annuity, you have different payout options. So payout is like the benefit, right? So you can choose to get your benefit for life. So okay, I want to receive benefit payments for the rest of my life. So that will be called straight life, right? So it would be called a straight life annuity. Another name for it is life only annuity. Another name for it is pure annuity, right? That is, I just want to receive annuity for the rest of my life, you know. Then
Okay.
the other payout option is I can have period certain annuity. So that means, okay, I want you to guarantee me that you're going to pay me my annuity within a certain period. Like, okay, I want you to pay my annuity within 5 years or within 10 years, right? So that's pure certain annuity.
Okay.
So they're going to pay you that annuity within that period of time. But if you die anytime within that 10 years or 20 years, then your beneficiary will get the rest. So that's pure certain. The other payout option you have is called fixed amount. What does fixed amount mean? Like Lexie, we're just going to give you a fixed amount. Let's say you have 1,000, you have $1 million in your annuity. So we're going to give you a fixed amount um, every month or every quarter or every year until that $1 million runs out, right?
Okay.
So once your $1 million runs out, then your contract is over. That's fixed amount. So the amount doesn't change. We'll give it to you until your money runs out. The other payout option we have is called the fixed period annuity. So that means, okay, we're not going to guarantee the amount, but we're going to give you all your money within this fixed period. So we're going to pay you your money within 10 years or within 20 years. Now, you may say, what's the difference between fixed period and that gets people confused? Fixed period and period certain. Period certain means that we want you to get all that money within this time. Let's say you have $1 million. So if you don't get your $1 million within 10 years, whatever is left, your family is going to get. But the fixed period annuity, right? The fixed period annuity is different. That means you know it's a fixed period. You don't get how you get you you're supposed to get your money within that time. But if you die, oh, bad luck, the insurance company gets to keep it.
Ooh. Okay. Good to know.
Yeah. Okay. So that's fixed period. Then you have another one you have is life with refund, life life income with refund. So what that means is we're going to give you, let's say you have $1 million, we're going to give you regular payments for life, but if you die anytime during your life, unlike the period certain, you have to die within a certain period, right, for them to
Okay.
give you. But this one, life income, it can be anytime you die during your, as long as we've not paid out that benefit yet, we're going to give your family a refund of the difference of what we owe you.
Okay.
So those are the benefit payment options. Again, when you go over those questions, the questions go into more details. You can be able to test yourself, but that's it. And then the last thing you have under annuities, you you have joint life, you have combination plans, right? So
Mm-hmm.
combine features of different things. So you have joint life annuities, right? You can also have joint life insurance, and you have joint and survivor. So it gets confusing. Just know joint uh, for joint life annuity. So it's two people covered under the same policy, right? Um, and those two people receive income. Most of the time, it's a husband and wife. So okay, you two of you get an annuity, and we're going to be paying um, two of you $500 a month. The difference is when one of you dies, the income payment stops.
Okay.
No more. Then the insurance company can wash their hands. Like, okay, so again, that's risky because let's say you have $1 million. If it's a joint life, the first person to die, the joint life annuity, and that is it. The insurance company doesn't owe you any more money, right? Bye bye.
Mm.
If it's a joint life insurance policy, the first person to die, the insurance company will now pay the death benefit, right? On the first death. So just know for joint life is insuring two people, but the first person to die, then the policy ends. So if it's an annuity, the annuity contract ends. If it's a life insurance, the life insurance contract ends and they pay the death benefit. Joint and survivor is the opposite. So it's still insuring two people.
Mm-hmm.
Death benefit is paid when the last person dies. So let's say a husband and wife have a joint and survivor life insurance policy. The death benefit, let's say the wife dies, they're not going to pay the death benefit. They'll pay the death benefit when the husband dies, the last person to die. And most of the time, the guy is the first person to die. So maybe that's the.
Yeah.
but uh, but but once the last person dies, then the death benefit is paid. When it comes to uh, joint and survivor annuity, the the annuity will continue to be paid even to the to the survivor. That's why it's called joint and survivor. So the survivor continues to receive the benefit,
Okay.
and that wraps it up here. So when we come
Okay.
tomorrow, I'll have you to no, I'll ask you questions. So I want to give you some time to go back. So your assignment is this. So your assignment for day 2 will even be more than day 1.
Okay.
And that's why it's called a challenge, right? Because I'm going to challenge you to do more than what you've been doing. So your assignment in what I sent you, number 1, go back now and I want you to retake all those quizzes, all those
Okay.
quizzes for the lessons for chapter 1. So I see that some of them you score 60, 55, all of that. So I want you to go back with your understanding,
Okay.
go back and now take all of those. Keep taking those quizzes until you score at least 80%. If you don't score 80%, don't move forward. Every time you feel it, go and read the answer feedback, right? The answer explanation, you have a detailed explanation of the correct answer, why is the correct answer stuff. So keep taking it, and this will take you about minimum 4 hours, right? Or it's going to take you longer than that, right? But the whole thing, one of the things we use here is repetition, right?
Mm.
You do something one time, you probably will forget 2 times, maybe. If you do the same thing 3, 4 times, you keep feeling it, but you go back and read the explanation, like, oh man, okay, now you test yourself 4 or 5 different ways for the same concept. You go to the exam, no matter how they twist it, turn it upside down, because you've seen it so many multiple ways, and you're going to pass. So that is what we do. So the same topic, when it comes to your final exam, we're going to ask you in a different way. The same lesson when it comes to the simulated exam, we're going to ask you in a different way. So you're going to be um, tested on the same concept 3 or 4 different ways. So when you go to the exam, you're prepared. So go through all the lessons for chapter 1. Again, don't move
Mm.
forward until you score at least 80%. If you keep feeling it, then you can watch the video lesson for explanation. For some people, the written feedback is good enough. but you can use both. Now, when you finish that, take the chapter one exam. Yeah, we're a little more intense, than most, than most pre-licensing providers. So our chapter exam, I think it's like 100 and something questions, 150 or something. So again, that's why it's called a challenge. This is something that people usually do in 3 weeks. You're trying to condense something in 3 weeks. You're trying to do it in 5 days, right? So it's
Yeah.
intense. So go and do chapter one. When you finish that, then your assignment will be to do chapter two. So now you're going to do, you're going to do the chapter two, all the lessons. If you can take them one time, that's good. At least try them one time. Read the um, feedback, the answer feedback to see
Hmm.
what you got it wrong. But for that one, you don't need to score 80%. At least take it one time. Read the feedback. So when you come, all those questions you have, I can be able to plug all those holes so it'll make more sense to you. So chapter
Okay.
two, go through all the lessons and then um, do chapter two exam. So all of what I told you right now will take you at a minimum 6 hours to do. It will take you
Okay.
even for 8 hours. I know it's crazy, especially if you're working and you got other things to do. It's crazy, but that's why it's called challenge, because the whole purpose of this is to prepare you for your exam within 5 days, or to get you very, very close where you just need a few more days of study. So it's challenging, but at the end, uh, it's going to be for your benefit. So I'll stop here. Any questions, comments? How are you feeling so far, day two?
No, good. I took a lot of notes throughout, so I think going back and reviewing my notes and will help me understand more as well. Um, and yeah, hopefully I can score better on all these other quizzes. That's kind of what I was doing watching the videos, and then I would go back and retake the quiz and score a lot better. Um,
Mhm.
so yeah, overall, I am grasping it a lot more than I would have just reading it and trying to understand what I'm reading that stuff I've never seen before.
Yeah. Okay. And I'll just put in a plug now for you and for those listening. So we also have our affiliate program, and for you listening on YouTube or on the podcast, I'm going to include a link for our affiliate program in the description. But the good thing is, when you now, if you like it, I'm assuming you probably like it so far. That's why you're here. You like the podcast and you came here, right? So if you like it so far, what about helping to get other people, to experience the same thing? But you're not just sharing with them. You're not just helping them out. You're also helping yourself, because now, as an affiliate, uh, depending on what it is, you get between 30 to 70% commission. So, for example, if it's our self-study course, it's $250. That's without discount. But if you get someone to come, you get, I think, about 70% of that, right? Which is crazy, which is more than $150. So, and the same thing for this challenge. So refer people, get as many people, and the more people you refer, it's a win-win for you, it's a win for them, and it's a win for us, because we get more people to help. So that is it. You've been doing a great job so far. So
Thank
I'll
you.
say, yeah, you're welcome. Without any other questions, if you don't have any other questions or stuff, we'll stop it here, and then we'll be back tomorrow,
Okay.
2 p.m., and we'll finish chapter two.
Okay, sounds great. Thank you so much.
You're welcome, Lexi, and you have a great day, okay?
You too. Bye.